The top business stories live from the Sky News City studio. As major lenders cut the cost of borrowing for homeowners, we'll speak to a new bank which wants to shake up the UK mortgage industry. After pushing back the target to 2035, the government sets out the new timetable to zero emissions vehicles. And reports that buyers are returning to the housing market following a summer of misery. Good afternoon, this is Business Live with me, Ian King. The interest rate on an average 5-year fixed mortgage has dropped below 6% for the first time in nearly 3 months. And that news comes as a new bank seeks to shake up the UK mortgage market. But according to the financial website Moneyfacts, the average 5-year fixed rate mortgage is now 5.99%. That's down from an average of 6.03% that was reported yesterday. Today's rate is the lowest since the 3rd of July, when a 5-year fixed rate stood at 5.97%. Well, joining me now is Arjan Verbeek. He's the Chief Executive and co-founder of Perenna, a new bank that claims to be on a mission to structurally change the mortgage market. And today it completed a $52 million funding round. Arjan, good to see you this afternoon. Can you give me an idea of what this values the business at post this funding round?
Oof, that's an interesting one. Probably around 125 million, I think, which I obviously think is too low, but that's because of the opportunity that we represent. But
now, your USP is that you're going to be offering 20 to 30-year mortgage products. They are very popular in the United States, but not so much here.
Yeah, that's correct. So the key is not 20, 30 years, but 20, 30 years fixed rate. It's the fixed rate that is important, because what many people don't really appreciate is the impact of the variable rate mortgages, short-term fixed mortgages on the housing market. Housing actually is not as unaffordable as people think it is. If we were to fix the rate and don't put all the market risk to individuals, to households, take the shock away, and we've seen inflation shocks, interest rate shocks, mini budget, there's a lot of issues, obviously. If you take that away from households who can't manage that, they can actually afford the housing. Housing is not unaffordable. It's the market risk that means that the banks have to cut the amount that they lend by about 20%.
Yes, often the redemption fees on long-duration mortgages tends to be quite high.
Yes, and that is exactly what people generally think, and also because of the regulations of insurance companies, pension funds, etc., that is the case. But we do it differently. So like in the US and like in Denmark, Netherlands, that doesn't have to be the case. We believe that consumers have to have that cake and eat it. So we fix the borrowing for them. There's one payment for the entire term, but after 5 years, there's no penalty. They can just repay, they can live their lives, and there's no restriction on them. So it's really that flexibility that's key.
Now, the other interesting thing about your business model is that you're not dependent on customer deposits. You're raising the capital in another way. What are you doing?
Correct. So our banking model is unique to the UK. We borrow the best from Denmark, US, Netherlands, etc., to really create the systemic stability that we borrow through bonds, very safe bonds, from insurance companies and pension funds, and that gives us the long-dated fixed-rate capital to make these long-dated fixed-rate mortgages and give that certainty to consumers. That is different. The banks on deposits cannot really do that because the risk is just too high for them if it's on deposits.
Yeah, because essentially they're borrowing short and lending long.
Exactly, yeah.
Now, you claim you've got a waiting list of 5,000 customers, potentially.
It's more now.
Right.
Yes, so we do. We have a lot of people on the waiting list. We actually have started. We have our first customers coming through the door, the virtual door, because we will not have branches. And it's going well. We've got more than 500 million potential on the list to complete. But obviously start slowly and then see what we do. And it's going, there is a big need. And the need is often, people say, who wants it? But a lot of people want it because it's all about affordability of debt. People need to make sure that they can afford it. And if you are a first-time buyer stretching yourself, you cannot. You can take a loan, but you need the highest loan possible. Yeah. If you're over 50, there are hardly any products anymore because of age limits. We don't have that. And those are real important segments of the market that we service, and the existing banks don't.
And typically, what sort of deposits will you be taking?
For us, we have a risk framework and we have a board to sign off. We need to go there. As a Dutchman, as you perhaps know, we have 100% mortgages in the Netherlands. It's not about the security, because you have to live somewhere. Nobody wants to give up their house. It's all about, can you make that payment every month for the entire term of the mortgage? So we determine the affordability of that payment. and then LTVs will go as high as we need to, as I can get sign-off from the board and everything.
And typically, what sort of multiple of someone's salary would you be prepared to lend?
So the multiples are a function of affordability. The multiple is an output, it's not an input. So we calculate how much we can lend to people based on their salary, their expenses, etc. And that will get to a multiple. At the moment, we probably are at a multiple of just about 4.5, roughly on average, but the other banks are at 3.
Yeah.
Because of that gap and the difference of the market risk that they have to, or they are putting to the borrowers.
And of the people on your waiting list, what proportion of them roughly are first-time buyers?
It's an interesting one. It's actually quite okay. I think roughly, from memory, I need to check because it changes quite rapidly all the time. It's probably about 20-30%, I think it is. The problem with first-time buyers, obviously, there's a long lead time. So we need to work with them and keep their borrowing power in place. So we really start to focus on the remortgaging, and then the first-time buyers is the next step, which is a bit more challenging.
OK, Arjun, great to talk to you this afternoon. Thanks very much indeed. See you again, I hope. Now, after intense criticism from some car makers of Rishi Sunak's announcement that petrol and diesel vehicles won't be phased out until 2035, the government has this afternoon set out its new timetable for zero-emissions vehicles. Well, joining me now is our business correspondent, Paul Kelso. So, Paul, what are the headlines here?
Yeah, the industry's been waiting for 2 years for the outcome of this consultation. This is what's called the Zero Emission Mandate. It sets the timetable, effectively, for phasing out petrol and diesel cars, new petrol and diesel cars from Britain's roads. We know the Prime Minister has just pushed back the final deadline from 2030 to 2035. These are rules that will apply from January the 1st, so the industry's been very keen to see them. And they set the percentage each year between now and 2035 of cars that must be zero emission, which effectively means battery electric vehicles. Be 22%, as the industry was led to expect, from next year, rising to just over 50% by 2028 and 80% by 2030, when originally it was going to be 100%, and then phasing up to that full 100% of new vehicles being zero emission by 2035. That means the industry can plan now with some certainty its production schedules and the like. For those companies that miss that target, there are pretty hefty fines, £15,000 fine for every vehicle you are under that percentage of your total production. But there'll be a market to trade from those companies that produce too many, who are overscheduled. They can bank those credits, if you like, and sell them. But the industry now knows where it stands. There's another shoe to drop, though, in terms of regulation, Ian, on electric vehicles. Still waiting to hear if, from January the 1st, the European Union's rules on rules of origin, how much of a vehicle's total value is derived from components made in the EU or the UK. That's much harder for electric cars because batteries make up so much of the value. Any cars that are outside those rules will face 10% tariffs on import and export from next year. That's massive, not just for British manufacturers, but it's huge for European manufacturers, particularly the German car industry, exporting to Britain. So lots of pressure, lots of lobbying from the German government as well as the British in Brussels at the moment. But this mandate, at least from the British end, gives some certainty to manufacturers moving into next year. OK, thanks, Paul. Some other business news stories for you now. And the recycling and waste management company Renewy has this afternoon rejected a takeover valuing it at £636 million. The would-be buyer is the Australian private equity investor Macquarie Asset Management. Well, Renewy, which used to be called Shanks Group, and before that, Shanks and McEwen, said it had studied the proposal in detail and believes it fundamentally undervalues its value and prospects. The company, which employs nearly 7,000 people across Europe, handles 14 million tonnes of waste annually, 89% of which is either recycled or used for energy recovery. Shares of Pepco, the parent company of Poundland, fell by more than 19% after it issued its second profits warning in less than 3 weeks. Pepco, which is listed on the Warsaw stock market, said underlying earnings for the year were now likely to be around €750 million, compared with €731 million last year. That would represent growth of less than 3% this year. Until the profits warning it delivered earlier this month, it was predicting growth of around 15%. Pepco also reported that a second senior executive is leaving the company. Its managing director, Anand Patel, will leave with immediate effect. The chief executive, Trevor Masters, went earlier this month.
And the drugs giant GSK today raised its medium-term growth forecast for its HIV drugs business. GSK said it was now targeting annual rates of sales growth of between 6 to 8% for the business, up from 4 to 5% previously. GSK, which claims to be the fastest growing company in HIV in terms of both sales and market share, said sales of Dovato, its prescription drug to treat HIV in adults who've not previously received HIV medicines, were expected to reach £2 billion next year. It also flagged the growing popularity of its petrol injection, which is an alternative to daily pills. Now, it's reported today that the decline in buyer demand in the housing market over the summer has started to reverse. The property website Zoopla says there are 12% more buyers in the market over the past month, although discounting is still going on for people desperate to sell their homes. Well, joining me now is Richard Donnell. He's Executive Director at Zoopla. Richard, good to see you this afternoon. Inquiries up 12% since the August bank holiday weekend. How much of that would be a sort of regular seasonal uplift anyway?
It's definitely seasonal, but I think it also shows, UK consumer confidence is back to a 2-year high. Base rates have stopped rising, mortgage rates are sort of coming down. So I think people who paused over the summer, and it started early, it started back in May when rates started rising. Some people are coming back into the market, most noticeable in London and the South East, where demand has really been hit by higher mortgage rates. So part seasonal, but also people thinking, how long can I keep delaying?
But this revival in sentiment came even before the Bank of England hit the pause button last week.
It did. It was starting to feed through on seasonal factors, but I think this is expected to continue. It's fair to say that demand for homes is still 30% lower than average, but there are people in the market who want to do deals, and transaction volumes are sort of holding up in line with 2019 levels.
So you mentioned London and the South East there. That's where demand has picked up most strongly. What about those countries, parts of the country where affordability isn't as much of an issue? Are things still fairly soft there?
Yeah, we've still got house prices rising in Scotland by nearly 2%. The average price of a house in Scotland, 40% below the UK average. And what higher mortgage rates really has done is really put the stress into the most expensive housing markets. It's increased the income for people to buy, suppressed demand, and that's where we're seeing prices falling the most.
Yeah, what about first-time buyers?
Well, they're actually holding up reasonably well, but they're heavily reliant on the bank of mum and dad. In the Midlands and the north of England, mortgage repayments on a property are still cheaper than renting. But in the south of England, it's more expensive to buy than to rent, even at 4.5% mortgage rate. So I think, but the pace at which rents are going up is forcing some first-time buyers into the market. But again, you need a lot of equity to be a first-time buyer.
Well, you do. I mean, how on earth what about those people who can't go to the bank of mum and dad? They're just stuck in the rental market for longer.
That's right, and that's what's really been driving rents. We've got 30 applicants for every home for rent on Zoopla at the moment. There's simply not enough, and rents are up about 12% year on year.
Now, you put out some interesting commentary today on the extent to which prices are selling at a discount to the asking price, 4.2%. How does that compare with the historic averages?
Well, it got down over the pandemic. The market was so strong that people were just getting the full asking price, which is not normal. Go back to 2018, it was up about 4%. So 3 to 4% is the typical discount a seller will give to a buyer to agree a sale in England and Wales. We're sort of back up to 4.2. It gets up towards 5% in London, the South East. But again, it's all about the willingness of those sellers to accept that reduction, because what you get for your home unlocks your next move for many people. So this is why transactions have taken the biggest hit in the housing market, down 20% this year to 1 million sales.
It's really interesting what's going on there. Where do you see the market going from here? I mean, there's a lot of hypotheticals at play here, Richard. If the bank keeps rates where they are for the time being, do you expect this sort of confidence to continue?
I think it's going to be a pretty weak end to the Q4 2023. I think it all depends on whether mortgage rates get below 4.5%. And I'm talking a 5-year fix at 75 loan to value, which is currently about 5.1 by the big banks. If we can get sort of 0.5%, 0.6% off mortgage rates, I think more people will come into the market early next year. But I don't see prices going up. It's all about getting more liquidity into the market, which I think is what a lot of businesses want.
What did you make of what we just heard from Arjun? I mean, that's quite an interesting business model he's got there, and quite an interesting product proposition.
It's really interesting, and I think, long-term fixed-rate mortgages, getting over some of these affordability hurdles, because even though mortgage rates for a new first-time buyer might be 5.5, those people have got to prove to their bank they can afford 8.5 or 9%. And I think his product is really interesting if we can get around some of these mortgage regulations and make it easier you do affordability-based lending over the long run, you can price more people into the market.
OK, Richard, got to leave it there. Good to see you today. Thank you. Still to come here on Business Live, we're going to have a look at how the markets have finished up this Thursday afternoon. Don't go away.
I'm Katie Spencer and I'm Sky News' arts and entertainment correspondent. When you think of Glastonbury, it's mud you want and music. They're going to cross to us live in a minute. Okay.
We always were capable of doing this.
Oh, they're wonderful children as an audience.
Who did that? Maverick here on the red carpet. I'm so excited. We take you to the heart of the stories that shape our world.
Nor have I ever struck any woman in my life.
There's this illusion of power.
Are you feeling well?
I remember covering the Oscars and that now infamous moment, the Will Smith slap. You can tell from these crowds just how excited people are for the return of Pride.
These actors playing the lead roles were born long after the Sex Pistols broke up.
As a team, we've interviewed some of the biggest stars in the world.
Okay, I'll talk to you.
Don't leave me.
Yeah, okay.
There's no easy goodies. There's no easy baddies.
Thank you.
Thank you.
Bye.
Slide Emirates. Slide better. Fly Emirates. Fly better. Thank you.
Welcome back. I just want to bring you some breaking news, which is that a number of people have been killed in the Dutch city of Rotterdam this afternoon after a man went on a shooting spree. That is according to local police. A 32-year-old man was arrested following the shootings, which began in a house and continued in a classroom in a medical facility nearby. Police have not specified precisely how many people have been killed. More on that as we get it. Well, news that German inflation fell this month to its lowest level since before Russia's invasion of Ukraine has given stocks in Europe a lift this afternoon. All of the main continental European indices have finished higher. Elsewhere in Germany, the medical vials maker Schott Pharma have risen by 11% on their debut. It's Germany's biggest stock market flotation so far this year. Well, here in London, the FTSE 100 has finished in positive territory, albeit only up about 1/10% on a rally for some of the mining heavyweights. In percentage terms, one of the leading gainers is Smith's Group. You'll recall we had the chief executive on our morning edition yesterday talking about his rather good results. Among the fallers, well, for the second day running, it's Ocado. There was a very hostile broker's note out on it yesterday. The stock has fallen by 30% since the close on Wednesday last week. Outside the FTSE 100, Babcock has finished up by 5.5%. That's on a trading update, while Mitchells & Butlers has finished up 4.25% for similar reasons. Over on Wall Street, the main stock indices have opened to the upside, but the S&P 500 and the Nasdaq are still on course for their worst month since December last year. Talking points on Wall Street today include Accenture, the IT services firm, off by nearly 5% after warning that full-year earnings will fall short of expectations. On the foreign exchange markets, meanwhile, well, after several days of drift, the pound has rallied by 0.75% today against the US dollar, more or less unchanged right now against the euro. The single currency, meanwhile, also up nearly 0.75% against the dollar. A bit of profit-taking in the dollar, one suspects there. As for the oil price, well, this morning it's hit a fresh 10-month high on concerns, again, over supply tightness. At one point it hit $97.69 a barrel, which was the highest since the 8th of November last year. It's sold off a little since then. Barrel of Brent crude currently changing hands at $96.23 a barrel. That's off 1/3%. Well, with me this afternoon is Bill Dinning, great friend of the programme, the Chief Investment Officer, of course, at Waverton Investment Management. Bill, good to see you this afternoon. The pound has not had a terribly good month, despite what we were saying there.
No, certainly against the dollar. I mean, it's against the euro. It's not really doing very much. And in fact, if anything, 1.16 euros per pound is actually, the pound's a little bit stronger than its long-term average, i.e. the post-Brexit referendum average is about 1.15. So I think we've always got to be careful with that. The dollar's being well supported by relative expectations for interest rates again. That German CPI number has increased confidence the ECB might be done. I think we're all hoping the Bank of England's done. But Fed officials continue to try and keep the window open for more hikes, and I think that support for the dollar is a dollar issue. Sterling weakness against the dollar, I think we need to look at it against the euro, and it's actually not that weak.
Very interesting to note the, I mean, normally the dollar and the oil price move in inverse correlation, but oil's had a very, very strong couple of months, as has the dollar.
Indeed. I think perhaps the issue for oil when it's, the high price of oil is going to have an impact on inflationary expectations. So, for example, in America, if the price of petrol at the pump continues to drift upward, you're also getting closer to, well, we're in the fall, as they would say, you're getting closer to, in the northeast and the Midwest, they're going to be turning on the heating, and consumers are going to be very conscious of those higher energy prices. That medium term will actually have a dampening impact on consumption because they're going to have to be spending more money on that. But in the short term, it affects headline inflation and it affects consumers' inflation expectations. So I think that supports the Fed being higher for longer, or maybe even higher than they are now. That narrative of higher interest rates in the States, whilst, as I said, we might be at the peak on this side of the Atlantic, that I think is potentially why the dollar's going up while the oil price is going up.
Well, feeding into that, of course, we had the German inflation number, things looking a lot better there. I mean, does that give you confidence the European Central Bank is now done with tightening?
Well, I certainly think for both the ECB and I think for the Bank of England, I do hope that, particularly here, I hope they are done. I think the weakness of the economic growth, the weakness of economies is there, I think, here. I think it's less visible in the United States, which, again, supports the relative narrative. But I think the ECB and the Bank of England probably pausing would probably be not a bad idea. But you're definitely right. The momentum of not just headline inflation, but also core inflation in the euro area decelerating as it has is encouraging.
Now, this has not been a great quarter for equities, certainly on Wall Street. What are you anticipating for the final quarter of the year?
Well, it hasn't been a good quarter, and it's been, as we've just said, interest rates have been going up, so it's been bad for bonds as well. It's a sort of replay of 2022, when you lost money in the gilt market, you lost money in global equities. We're seeing something similar in this quarter. I do think there are potentially some challenges ahead. One of those challenges is those persistently higher short-term interest rates and bond yields mean that there's competition to the stock market. So if you look at the stock market from the point of view of an earnings yield, so looking at the earnings relative to the price, the earnings yield is lower than what's available in the corporate bond market, and it's actually now lower than what's available in a 3-month Treasury bill. And you haven't had that for decades. And that basically means on a relative basis, the stock market, I think, has some challenges at the headline level. But there are lots of great companies in the US, and a lot of them are trading at reasonable valuations. So I'm not uber bearish, but I think the stock market could continue to struggle in the short term.
All right. Good to get your wisdom as ever, Bill. Thank you. That's it from me. I'm back again at 11:30 tomorrow morning. Hope very much to see you then. My guests are going to include the Chief Executive of Philips. Do tune in for that. Next up, it's Mark Austin with the NewsHour. Cheerio.